we have to eliminate all intra-group transactions. So no matter this is a sales from the parent to subsidiary, or from the subsidiary to parent, or actually even from one subsidiary to another subsidiary, this kind of intra-group transaction must be eliminated. Sometimes we call the sales from parent to subsidiary a downstream sales, a sales from subsidiary to parent and upstream sales. The accounting treatment on consolidation will be a little different depending on whether it is a sales from the parent or it is a sales from the subsidiary. Take a sales from the parent to subsidiary as an example first. If parent sells something to subsidiary, we make an assumption that this is the sales by the parent and therefore the profit is realized, the profit is recorded, the profit is gained by the parent. If this is a profit gained by the parent, it has nothing to do with the profit of the subsidiary. And because it has nothing to do with the profit of the subsidiary, it will not affect the non-controlling interest because non-controlling interests are shareholders of the subsidiary. The other way around, if this is a sales from the subsidiary to the parent, we think that the consolidation adjustments is a consolidation adjustment on the profit of the subsidiary. Because this is a consolidation adjustment on the profit of the subsidiary, therefore, we need to ask the non-controlling interest of this subsidiary to bear its portion. Okay, so whether it is downstream sales or upstream sales, it's just a name. Actually, if subsidiary 1 sells something to subsidiary B, we will ask the non-controlling interest of subsidiary 1 to share. If subsidiary 2 sells something to the subsidiary 1, we will ask the non-controlling interest of subsidiary 2 to share part of the adjustments. So that's why it depends on whether the parent is the seller or the subsidiary is the seller. We will ask the non-controlling interest of the subsidiary which sell to bear the adjustment, consolidation adjustment. Take the downstream sales first. In this example, P invested in 70% of the shares of the subsidiary. The tax rate is 20%. So let's see the intra-group transaction. In 2009, there is a sales of inventory from parent to subsidiary. No matter it is from parent to subsidiary or from subsidiary to parent, this is an intra-group transaction. If now it is 2009, so this is a current year intra-group sales. So if this is a current year intra-group sales, we must debit away the sales and credit away the cost of goods sold. This is to eliminate the intra-group sales. And from the information, we have been told that the original cost is 50,000. So therefore, potentially, the inventory may have been overstated by 10,000 because originally it should be 50,000. After the sales, we think that this is 60,000. So potentially, the overstatement of the inventory can be 10,000. However, the question said, percentage unsold to third party at the year end is only 10%. So only 10% of this remain in the closing inventory. So only 10%. So out of the 10,000, only 10% remains. So therefore, we only credit inventory 1,000. Whenever you credit inventory, you need to debit cost of goods sold. Again, we will combine these two journal entries into one. Therefore, you may debit sales 60,000, credit inventory 1,000, and credit cost of goods sold 59,000. Another way to see why we have to credit inventory 1,000 is Now only 10% remain, so therefore only 10% of this 60,000 and 10% of the 50,000 remain. So originally, this 6,000 closing inventory now you have recorded, actually the original cost was only 5,000. So we must bring down from 6,000 back to 5,000, and therefore you have to correct the inventory. The correct closing inventory should be 5,000. Again, because of this consolidation adjustment, there will be a deferred tax implication. Because you credit the inventory, we debit deferred tax asset. Because you debit cost of goods sold, we credit tax expense. There will be no impact to the non-controlling interest because this is a sales from the parent. We will not ask non-controlling interest to share any adjustments. This is the situation for 2009, which is the year in which the intra-group transaction happened. Assuming that now it is 1 year after. 1 year after, this means 2010. So in year 2010, because neither the parent nor the subsidiary has recorded those consolidation adjustments, so therefore as a consolidation accountant, I will repeat what I have done last year. I don't need to repeat this first journal entry. I don't need to debit retained earnings and credit retained earnings. But I need to repeat this journal entry because it has got a one-side effect on retained earnings. So therefore, I repeat this journal entry. Last year, it was a cost of goods sold. This year, I debit retained earnings. I still need to credit the inventory, right? So if I just repeat this journal entry, I need to debit retained earnings and credit inventory. However, the question says that by the end of 2010, 4% of this inventory remains. So out of the 10%, 6% has been sold, has been realized. So if 6% out of 10% has been sold, 6 out of 10. So therefore, we don't need to credit all this inventory because out of this credit inventory 1,000, 6% out of 10% has been sold. Therefore, we debit back the inventory 6 out of 10, that means 600. So we debit inventory 600 and I credit cost of goods sold 600 because whenever you debit inventory, cost of goods sold will be smaller. So we credit cost of goods sold. So we may combine these two journal entries into one. So if I combine these two journal entries into one, I will debit retained earnings 1,000. That means last year's this 1,000 profit not yet realized. So out of which 400 remains because 4% of this 10,000 remains. 4% of the 10,000 is 400. So still we need to credit the inventory 400. And out of this 1,000, 600 has been realized. When we credit cost of goods sold, profit for the current year increase. So this is the consolidation adjustments at the end of 2010. Again, we have to repeat this deferred tax implication. So we debit deferred tax asset. Last year it was a tax expense. This year we credit retained earnings. And again, just like what we have shown here, 6% out of 10% has been realized. Therefore, out of this deferred tax asset, 6% out of 10% should be reversed. So we credit deferred tax asset 6% out of 10% of 200, right? And then because you have got the cost of goods sold, so therefore we debit tax expense 20% tax rate. So again, there's no adjustments for the non-controlling interest because this is a sales from the parent to subsidiary. Therefore, there's no adjustments to the non-controlling interest. So there is no adjustments to the non-controlling interest if this is a sales from the parent. What happens if this is a sales from the subsidiary? So if this is sales from the subsidiary, we'll ask the non-controlling interest of that subsidiary to adjust. So P invests in 70% of the subsidiary, everything similar, except the fact that this is a sales of inventory from the subsidiary to parent. The intra-group sales is 20,000. If this is year 2009, this is a current year intra-group transaction. Therefore, we must eliminate this intra-group sales. And therefore, we debit away the sales, 200,000. We credit cost of goods sold, 200,000. Potentially, the overstatement of the inventory can be 30,000 because the original cost should be 170,000. So potentially, the inventory can be overstated by 30,000. However, the question says that percentage unsold to third party at the year end is only 30%. So not all the inventory remains, only 30% remains. So 30% of the 30,000, we credit inventory 9,000. So closing inventory should be reduced by 9,000 because we have overstated it, right? So it should be only 51,000. Why? How to calculate 51,000? Because originally it was 170,000, 30% remain. However, after the sales, you think that 60,000 is the closing inventory. So 60,000 minus 51,000 is this 9,000. So we credit inventory 9,000. Whenever you credit inventory, we need to debit cost of goods sold. Again, we can combine these two journal entry into one. So therefore, we can debit sales 200,000, credit inventory 9,000, and credit cost of goods sold 191,000. Again, there will be a deferred tax implication. Because you credit inventory, you need to debit deferred tax asset. Because you debit cost of goods sold, we need to credit tax expense, 20% tax rate. This is a sales from a subsidiary. Therefore, we will ask the non-controlling interest to bear part of this consolidation adjustments. By this consolidation adjustments, right? You said that the profit should be reduced by 9,000. Therefore, we should reduce the profit by 9,000. Right? 800,000 is only the profit reported by the subsidiary. But the report of the subsidiary think that they have already sold this inventory successfully and earned all the profits. But on consolidation, we think that's 9,000. Not yet realized. But there is a related credit to the tax expense, 1,800. So we increase back the profit because of this credit to the tax expense. So the net impact is 9,000 reduction with a related credit to tax expense. So the adjusted profit should be 792,800. 30% will be shared to the NCI. So we debit profit to NCI and credit NCI for this adjusted profit. This is for 2009. Now it is 2010. 1 year after, strictly speaking, I have to repeat this journal entry as a consolidation accountant. On consolidation, I will repeat. I don't repeat the first journal entry, but I need to repeat the second one because there will be a one-side effect on the retained earnings. So I debit retained earnings and credit inventory. When we debit retained earnings, if you simply debit retained earnings 9,000, that means the adjustments has been borne by the parent completely. Retained earnings is the retained earnings to the parent. We understand that this is a sales from the subsidiary. Therefore, we should ask the non-controlling interest to bear part of these adjustments. So instead of debiting retained earnings all the 9,000, this is a 70% subsidiary. So therefore, 30% should go to NCI. So therefore, we debit retained earnings 70%. We debit NCI 30%. And we credit inventory. We need to share between the parent and the non-controlling interest. because this is a sales from a subsidiary. After we know that this is the end of year 2010, and the question says that actually everything has been realized. The closing inventory is 0% already. So that's why this credit to the inventory is no longer required. So we debit away this inventory 9,000. Whenever we debit inventory, we need to credit cost of goods sold. Of course, we can combine these two journal entries into one. Therefore, you simply debit retained earnings 6,300, debit NCI 2,700, and credit cost of goods sold 9,000. The same for the deferred tax, right? So you credit tax expense. Last year it was a tax expense. This year is a retained earning. If you simply credit retained earning for all the 1,800, that means you ask the parent to bear all the adjustments, right? We should not do so because this is a 70% subsidiary and this is a sales from the subsidiary. So we will ask the non-controlling interest of that subsidiary to share. So therefore we credit retained earnings 70% and we credit NCI 30%. So again, just like what we have done here, because everything has been realized, so this deferred tax asset is no longer required. So we credit away all this deferred tax asset. When we credit deferred tax asset, we debit tax expense. Again, you can combine these two journal entries into one. Now, for last year's profit, last year's profit was 800,000. 800,000. This is for the retained earnings now because this is last year's profit, so that's why it is the retained earning now. So for this retained earnings, we have already adjusted. We have already adjusted in the individual journal entry, right? So therefore, here we don't need to do any adjustments. So we simply share 30% of this 800,000 to non-controlling interest. So we debit retained earnings and credit non-controlling interest. If we have not shared between the retained earnings and the non-controlling interest here, if you simply debit retained earnings 9,000 here, that means you did not share it to the NCI. Then here you may need to do some adjustments like this, right? For that 9,000, right, we should reduce the profit. For this 1,800, right, 1,800 last year, we should reduce the profit. So that's why if we have not done this sharing of the profit between the retained earning and the NCI here in the individual journal entry, we actually have to adjust here. So therefore we have to debit retained earnings 237,840 and credit NCI 237,840. But usually I recommend you to adjust in the individual journal entry, this so that you know that you have to share between the parent and the non-controlling interest. And also, because if we do not do it in the individual journal entry, here there will be many adjustments, right? Because everything relating to the retained earnings should be adjusted here. So therefore, a lot of adjustments. So therefore, I recommend you to adjust in the individual journal entry. And therefore, when we share the retained earnings, we don't need to do any adjustments at all. Now, talking about the current year profit. The current year profit is 900,000. 900,000. If we don't need to do any adjustments, we will simply share 30% of the profit. However, this is only the profit reported by the subsidiary. So we start from this 900,000. And then we know that in the current year, what we have done, in the journal number 2, you have credited cost of goods sold. Journal number 1 have no impact on current year profit. Journal number 2, you credit cost of goods sold, that means the profit should go up. Journal number 3, no adjustments for the current year profit. Journal number 4, you debit tax expense. So therefore, the profit should go down. So because of this journal number 2 and journal number 4, we have to adjust for the current year profit. Profit should go up by 9,000. Profit go up because now you really sell the inventory to outside party. So the profit has been realized with a related tax expense on deferred tax. Therefore, the adjusted profit is 907,200. 30% should be shared to NCI. Therefore, you debit profit to NCI and credit NCI. We need to share this to NCI. We need to do these adjustments because this is a sales from the subsidiary. And also for the current year profit, if we can still remember the structure of our consolidated income statement, everything for the sales, cost of sales, etc., it is 100% of the parent and 100% of the subsidiary. Therefore, we cannot adjust directly between the parent and subsidiary in the sales, cost of sales, etc. So income and expenses, assets and liability is 100% of the parent and 100% of the subsidiary. We don't adjust. But for the retained earnings, we share between parent and non-controlling interest because retained earning is the retained earning for the parent only, right? So therefore, we cannot adjust the profit figures, the sales figures, etc. in the individual journal entry, and therefore we can only adjust here. So therefore, we debit profit to NCI and we credit NCI for the adjusted profits.